listen-only mode.
Oh, good morning, everybody. This is David from Heathcote Investment Partners here. Thank you for joining us this morning. Today we've got Michael Haddad, Principal and Senior Portfolio Manager for Peters MacGregor Capital Management. And Michael's going to provide an overview and update on their global equity fund. Just before I hand over, a couple of very key points on who Peters MacGregor are. They're a bottom-up value-based long-only investment manager, and their focus is on preservation of capital. The global fund invests in a concentrated portfolio of global securities and cash, and six outstanding businesses that are traded with a wide discount. Before I hand over to Michael, a couple of things. We'll keep everybody muted during the presentation, just keep noise levels down, and we'll open for questions at the end of the presentation, which should last about 20 minutes. I think we're just getting a bit of feedback there. That might just be coming from Michael's end. As I said, you can type any questions that you have during the presentation, and I can relay those to Mike at the end if you prefer. So look, with that, I'll hand over to Michael. Thank you.
Thank you, David, and thanks everyone for being there. We are getting a bit of background noise there. David, is the call talking okay to you?
Yeah, it's clear. We are getting a bit of background noise, unfortunately, which I think is at your end. That's
right,
better.
okay.
That's better now. Yeah, that's better.
Okay, sorry about that. All right, so getting straight into the presentation there. Thanks for your introduction there, David. Here's our disclaimer, which I think is I'm sorry. I'm sorry for that noise. Okay, so moving straight in. So just in terms of some background on the firm. So we're a Sydney-based global equity manager. We have a value-based philosophy on investing. We're seeking to purchase great companies with great management that we can purchase at a material discount to our own assessed valuation. Our firm was established in 1999 by Wayne Peters, and we have a 16-year strong track record of outperformance. I joined Wayne in 2002. We've worked together 14 years. We're a team of 5 in total on the investment team. Wayne is Chief Investment Officer. I'm Senior Portfolio Manager. We have a Head of Research and 2 analysts working with us. In terms of our process, we spend significant time abroad seeking to form deep understanding on the businesses that we may invest in. We have a completely bottom-up approach to constructing portfolios. So we're completely benchmark unaware, and we're seeking to own a concentrated portfolio, as David was saying, of 15 to 30 stocks. Cash is always a byproduct of that process. It can range between 0 and 30%, and currently is sitting around 19% of the portfolio. Here's a brief fact sheet on the fund, which we'll leave with you. And moving into our track record. So there are three key messages I'd like to leave with everyone in terms of our long-term track record. First off, over any short period of time, we'll be quite different from the benchmark, and that's a function of being as concentrated as we are and of being completely benchmark unaware. You can see from the 3-year numbers there, for example, that we've underperformed by just over 2% per annum over that time frame. But very importantly, over the long term, we've generated significant outperformance. You can see from our 7 and 10-year numbers there, outperformance in the range of 3 to 7% per annum. Very interestingly, from a client perspective, is our relative low correlation. So if you look at the final row there on this table, we have relatively low correlation with the market and with competitors. And we have soft copies of this presentation available in the back of the appendices as a correlation matrix which shows us compared to our major competitors. Now from a blending perspective, this is very useful for our clients, and the feedback has been that our clients have a reasonable expectation of a modest amount of outperformance in using us. They may have a similar expectation with other managers that they're using, and blending them together, given the differences there and the low correlation, they're able to achieve lower overall portfolio volatility without giving up expected returns. So a very powerful tool. Here's a graph basically showing our performance since the market trough through the GFC. So we've performed quite well relative to competitors coming out of that very difficult period of time. Just in terms of an update on the bigger picture and where we're seeing markets today, what's been interesting in the last few years is with very low interest rates, the markets have reached very high levels. So the most marginal investor has been teased into the market due to the low interest rates they're able to earn in low or no risk securities, and this is quite concerning. Also concerning in more recent times, past 12 to 18 months, has been the increasingly narrowness of the market. So a decreasing number of companies have been holding the market up and driving it forward. You know, the so-called FANG stocks, Facebook, Amazon, Netflix, and Google. These companies have reached nosebleed valuations. In some instances, you know, 200-300 times earnings. So we think we're in a very dangerous market in that sense. We also think we're in a very low growth, broad economic environment. So taking a long-term view from here, we think that the high levels of debt will result in relatively low growth, and we think we're very much in a volatile world. So given where the markets have reached, we think it's very important that we're very mindful of the assets that we're holding. We own quality companies with good management that are priced sensibly to provide strong returns moving forward. Here's a snapshot of our top 10 holdings at present, and we're happy to speak to any of these during the Q&A or offline if you prefer. Just speaking to the changes in the portfolio in recent times, so while we are concerned about the broad market environment and the levels that it has reached, we're very excited about the opportunities that we're facing on a stock-by-stock basis, and we've had a few interesting changes in the portfolio. We recently had the sale of Precision Castparts. That company was acquired by another holding of ours, Berkshire Hathaway, and this was a 6% weighting in our portfolio, so a significant amount of cash coming into the portfolio as a result of that sale. We have mixed feelings about the sale. We feel that the price was slightly on the low side. We're certainly glad it's going to Berkshire Hathaway, and we'll have some exposure through that investment, but we would have much preferred to retain our holding as a separate independent company. Very interestingly, Fiat recently spun off its stake in Ferrari, which we subsequently sold. So when Ferrari hit the market, it was trading at a very attractive price, a very high multiple of around 30 times earnings. We think it's a really great business. We were very enthusiastic about our exposure to Ferrari through Fiat, and it was a key attribute of our investment thesis in Fiat. But as an independent company, it was simply priced too high for us. So we exited that position promptly. We retain a relatively small position now in Fiat. So post the spin-off of Ferrari, our weighting to Fiat has fallen to around 4% of the portfolio, which we're comfortable with at these prices. We're very excited about a substantial new position that we've taken in a company called Liberty Media. Now, Liberty Media is a company controlled by John Malone, who is a famed cable TV operator in the US. It's a holding company essentially for a 60% ownership stake in Sirius XM, which is a separate listed company, and Sirius XM is the only satellite radio company in North America. It's a very unique economic and business model that we're very excited to be able to gain exposure to at a very attractive price through the Liberty Media holding company structure. Just in terms of some background on Sirius XM and how that industry works. So we all have AM and FM radio in our cars, but in the US you have another option called XM, and That's satellite radio. They have these satellites, and each car needs to have the hardware installed to be able to receive the signal. It's a unique model, and the barriers to entry are extremely high. So high, in fact, that previously these companies were actually Sirius and a separate company, XM. Each company was spending a significant amount of money on content to stream to their customers, and they simply were unable to achieve the economies of scale to operate profitably. So both companies were losing money, and as a result, after a strong battle, they were able to get approval to merge, which created a very strong economic model for them, and they're able to then leverage their content across a much larger customer base. So a very interesting history there in terms of creating what is a uniquely strong economic model. From a consumer perspective, how it works is you subscribe for the satellite radio, you pay around $14 per month, so that's around 40 cents a day, and you get ad-free content, and you get the choice of hundreds of channels. So a really premium and superior service to what's available for free in the US. And it's important to recognize as well that in that market, there's a very different driving culture. So people will spend hours a day sitting on the freeways. It's sort of mindless driving, and they're really a captive audience to interesting content. One of the well-known programs that they have is the Howard Stern Show, and that was a major driver in the industry, growing as much as it has in recent years, though the industry is less sensitive to that specific type of content now. So what we think is a very interesting business. There's a secular growth profile with the company. We expect it to grow somewhere in the high single-digit % range in terms of its top line. They're able to put their prices up over time. We think it's prudent for them now, while they're still in a high growth phase, to keep their prices relatively low so they can take on more customers. But as the business matures, they'll be able to put their rates up, and they'll get a lot of operating leverage from doing so. So some of the increase in revenue over time will be spent on improving the quality of the content, which further reinforces the consumer proposition, but a good portion is retained for the shareholders of the company. So what we think a very strong economic model, and we're very excited about the prospects for owning a business like this in our portfolio. So just to summarize where we're at in markets today, as I said earlier, we believe this is a relatively low growth environment that we're in. The high levels of debt will need to be worked out over time, and we think that will have implications for companies. With a lower economic growth environment and a richly valued stock market as a starting point, we just feel this is very much a time for active investing. We think what has worked well over the last few years won't necessarily work well moving forward. We think that it will be critical for investors to avoid overvaluation in the markets. So one of the big dynamics over the past few years has been the significant weight of capital coming into markets via exchange traded funds, so low cost index funds, and these funds ultimately have been bidding up these large companies that were already at very high valuations, and that's really what we believe is driving companies that are at 50 or 100 times earnings to go to 150 or 200 times earnings. This is not based on rational analysis. This is based purely on the weight of capital in our view, and we feel that this is leading to a very interesting setup for long-term oriented value investors who are able to sort through the companies, look for good quality businesses with great management teams, and purchase those at sensible prices. So with that, that sums up the formal presentation, and I'd be happy to take any questions.
Thank you for that, Michael. I've just taken everybody off mute, so if there are any questions, please feel free to ask them. Just while you're thinking of any questions, I have had one which came through while you're presenting, Michael. It was, I mean, are you finding it increasingly difficult to find, you know, kind of good valued companies at the moment to buy into? And if you are finding it difficult, what are the options to you? Do you hold more cash? And if so, how much cash can you hold while you're waiting to find those good opportunities?
Thank you, David, for that. Look, I think what's interesting is that over the past year or 18 months, while the markets are very high, broadly speaking, we're starting to see increased dispersion in that, as I was saying, companies like the so-called FANG stocks, Facebook, Amazon, Netflix, and Google, and other hot stocks of the day have been going up very strongly, while most companies have significantly underperformed the average. So it's a very interesting environment where, you know, over the past 12 to 18 months, most companies have done worse than average. So we're still able to find interesting opportunities. When you look at our cash balance today, we're at around 19% cash, which is a fairly ordinary level of cash for us. It's neither particularly high or low, and that really, as I said earlier, it's completely a byproduct of the investment process, and it shows that we are able to find interesting companies, and notwithstanding the rich, broad market environment. What I'll also add is, you know, we seek to find opportunities often in complex situations. So I spoke about Liberty Media. That was complex in the sense that that company's principal asset is a 60% ownership of another company, which we're very much interested in. There are some other small assets in Liberty Media, but the significant majority of its value is in SiriusXM, and it actually takes significant work to understand the underlying assets of these companies, and so that's a real area of opportunity for us. We had a similar situation with Fiat, and now when we originally bought Fiat, we felt that the market was not fully appreciating the value of Ferrari as a component of Fiat, and Ferrari's economics were far superior to the average of the rest of the Fiat group of businesses. So if you're prepared to go out there and do the work, we think you can find opportunities, and obviously we have an open mandate where we're unconstrained in terms of you know, needing to reference the benchmark. We're able to simply focus on finding 15 to 30 of the best opportunities we can to own on an absolute basis for our clients.
Thank you, Michael. Does anybody have any other questions for Michael? Okay, well, I think you're off the hook there, Michael. Look, what I would say, if you do think of any questions, please do either email them through to Clayton or I'll give us a call, and we'll certainly get the answers to you. I don't know whether you've got any other comments you want to make, Michael, on your presentation, or any other observations you've had of the markets of late.
Yeah, thanks, David. Look, thanks everyone for being there. I guess the only other comment, and I guess a question that we've had a couple of times, has been around currency. And no, we know in the recent sort of few months the Australian and New Zealand dollars have both been quite strong. We've viewed that as an opportunity to potentially add to foreign currency exposure, and we think it's important ultimately that clients aren't necessarily trying to time you know, putting on currency exposure, but are thinking more fundamentally about, you know, the broad asset allocation and having foreign assets as a component of a broad portfolio. We believe is very important, and we take the recent bounce as an interesting opportunity potentially to add to foreign currency exposures and foreign asset exposures, or for those who haven't yet put exposure on, we think it may, you know, be a good opportunity to do so.
Thanks, Michael. Oh, well, look, what we'll do, we'll conclude the webinar then. We will, as always, we'll make the webinar available. We'll send out a copy of the presentation slides to all those who have attended today. As I said, the webinar will be on our website, and we'll also upload it onto YouTube so you can watch it later if need be. So, look, thank you very much for taking the time to do that, Michael. Much appreciated. And that's it. So with that, I shall conclude and thank you all for attending. Thank you.
Thank you.